Hello, my name's Andy Critchlow. I'm head of news at S&P Global Commodity Insights, and welcome to the Look Forward podcast from S&P Global. In today's rapidly shifting markets, success depends on anticipating what's next. The professionals who excel are those who can spot emerging trends before they fully materialize. The Look Forward podcast delivers exactly that. Insights to help you prepare for tomorrow's opportunities and challenges. We bring you expert perspectives on macroeconomic trends, capital markets, energy transition, and global trade, with a sharp focus on what these developments mean for the decisions that will shape your tomorrow. This podcast connects you with S&P Global's Look Forward Council, bringing cutting-edge research on long-term trends and transformative market shifts. Together, we're committed to providing the forward-looking intelligence you need to navigate uncertainty with confidence. Welcome, everyone, to this edition of the Look Forward podcast. My name is Andy Critchlow, head of news at S&P Global Commodity Insights, and I'm delighted today to be joined by my colleague Nathan Stovall, head of FIG research at S&P Global Market Intelligence. I've just started reading the book 1929 by Andrew Ross Sorkin about the Great Crash. It's a subject that's definitely in the public domain at the moment. People are talking about this. How do they start, these financial crises? You know, you as a journalist, you reported on a couple of them, but you've got a bit of a historical interest as well, Nathan.
I do. If you're going to cover the banking sector, you need to think about this. They're thermometers of the economy, and really a good litmus test of when things are getting out of whack. And I think it's really two very simple, high-level things. Valuations get completely stretched, and often that usually happens because we get over our skis. We borrow more than we have. And I think in both cases, what gets us there is that we've convinced ourselves that there's something new that changes the narrative, that says that this time is different, that allows us to take excessive levels of risk and allows us to justify, one, valuations getting to a certain level, or two, borrowing into a certain level. We're having that comp to 29 now, given what we're seeing, in the broad markets right now, with valuations going to levels that we saw, call it in the late 90s, early aughts with the dot-com bubble. It's a little bit different because you've got real earnings power at some of these companies, but a lot of it is rhymes with what you've seen historically, which is the expectation for something to happen, and that we pumped up valuations on that basis. But I often look at it as the health of the economy, health of the consumer, and health of the banking system. And one positive thing I'll say this time is, while there's some flashing yellow out there, particularly when it comes to U.S. banks, there's a number of reasons to believe that we're not heading towards calamity. The capital levels are very strong. Leverage is not excessive broadly across the U.S. consumer, though there are pockets of it. And that underwriting appears to be better than it has been in the last cycles. The issue is a lot of that risk still exists. It just might be outside of the system. And the question is, if they get it wrong, what are the knock-on effects for the traditional financial institutions?
So, people getting in over their heads, irrational exuberance. One area that's a concern increasingly, I think, for central bankers, for economists, for policymakers, is this area of private lending. And we've seen sort of little flashes of this recently in the US, right?
Yes. And effectively, you've seen that asset class grow considerably since the financial crisis. And really a couple reasons. One, a prolonged era of lower zero rates. So we do what we do well when it comes to capitalism. Capital finds the better return. When rates are near zero, you're going to take more risk to get returns. And so a lot of money found its hand in private credit because of that, outside of traditional fixed income assets. And the second being, after the financial crisis, you have a appropriate response to say we weren't regulating this correctly. We didn't have everything under the tent. We needed to. We need to change the way we're doing things. But as a result, you've pushed risk out of the system. So private credit has grown. It's almost 2 trillion. Globally, they've taken big share from banks, but banks have also decided we're not going to cede share completely and have increasingly been lending to those firms as well. And we can dig into further some of the mechanics there. But what you referred to, what we've seen in third quarter earnings is you've seen some blips on some of those loans from regional banks in particular, where they were pretty big lumpy losses and kind of spooked the investment community. We're not in the camp that is going to be very widespread, but we also are in the camp that things probably get a little bit worse from here, and that's one of the areas of concern.
And this is the area specifically around, some sort of consumer finance, so things like car loans, etc. Right?
That's where we're seeing some of the first cracks. That's right. Where you've seen some of the subprime lenders, and you've seen also cases of fraud, and you're starting to see things both within this bucket that could be private credit. The way it's defined in the U.S. is loans to non-depository financial institutions, which have driven a lot of the loan growth year to date, and there's breakouts within there. And you've seen some lumpy losses there, but you've also seen cases of fraud. And those are the kind of things you often see early cycle. Everybody in the bank group and much of the sell side community is pointing to it as one-offs. Well, if there's a bunch of one-offs or cases of fraud, those are the kind of things you start to see when people get a little bit stretched, they get a little bit desperate, they commit fraud. It doesn't mean that we're headed towards calamity, but those are the kind of things you see early, and this has gotten plenty of play, and it was a great quote, but it's also one that I think is accurate from JPM CEO Jamie Dimon saying, when you've seen one cockroach, there's another. And that's kind of, I think, encapsulates the point there. When you get a series of one-offs, are they really one-offs, or are they more sort of a start of a cycle? And we think we are heading where at least late cycle, and in terms of the healthy environment, meaning sort of starting into a credit cycle, but continue to believe that it's one that will be manageable for U.S. banks. But there's going to be bigger problems outside of the system for sure.
So S&P Global recently revised its GDP growth forecast to around 1.9% for 2025 and 1.8% for 2026. So these are below historical trend lines. I think given, the volatility in the US? I mean, there's been certainly a lot of policy surprises, some would say. Tariffs, the geopolitics, obviously, and we haven't really fully seen, right, the impact of tariffs yet. But, given everything that's happening elsewhere in the world as well, is that a good performance? Is that, how do you rate that? How does it feel in the US economically at the moment?
I think volatility is quite fair. To say that you could set your watch to what we've seen from the policy or geopolitical front, I think would not be a correct statement. And I think your point about feeling the impact of tariffs, we haven't yet. A lot were delayed. We didn't know where they were going to set. And the line I've been using there is, if you think public companies will simply eat a higher cost and let their margins go down and miss earnings over time, you are sorely mistaken. They will either pass it on to their customers or they won't hire as much. And we've seen a number of weak prints in the labor market over the last few months. And you wonder if some of that's showing up because of that. You wonder if some of it is maybe AI and companies increasingly adopting AI and solutions, deciding they're not going to hire as much, or a little bit of both. But it feels okay. And I think part of why it feels okay is 2-3 months ago, you might have considered all those things and thought things were going to be much worse. But we kind of keep chugging along. It's very much a consistent conversation that's been going on for much of this year. Consumer spending is holding up. The consumer's remaining resilient in the face of all this volatility. But it's split. It's K-shaped recovery. It's middle income, higher income earners driving a lot of the spend. And the lower income segment is getting hurt much worse. And part of that is because inflation is a much bigger tax on them. And tariffs, you could say, are a similar tax on them in terms of the potential for higher prices than the higher income earners who've really benefited from asset assets going up. That's who owns the assets in the U.S., whether you're talking about real estate or stocks and bonds. So it feels pretty good. The consumer remains resilient, but not great. And what most of the banks that we've heard of the last 2 weeks talk about is that they feel okay heading into 26, and they're not flashing, any real alarms. And it's pretty surprising to a lot of people when you take a step back and think about all the noise that has occurred, that we are kind of chugging along. But one of the reasons for that, and we point this out all the time, is the consumer has a pretty strong balance sheet right now, and 70% of the U.S. economy is driven by the consumer. If you look at household debt to income going all the way back to 1990, we're right at that pre-pandemic average. If you look at it in '08, we were at 13.1%. We're at 11.1%. So we were 2 percentage points in '08 above. We were out over our skis. We're not there as much. Part of that is because we threw a bunch of money at the consumer during the pandemic, and it lasted longer than people thought. And the other is 70% of household debt is in mortgages, and most of them are fixed rates. So when rates went up, that money the debt service didn't go up that much. That's a big reason why the consumer has held up more, and we're not seeing delinquency trends broadly get much worse. You are seeing it, as we talked about earlier, on those lower income segments, subprime auto and things like that. That's where you're starting to see the stress, and we expect more of that to occur. So kind of that continuation of, call it a K-shape, for the next few quarters.
How does this kind of reflect on bank balance sheets? How important, I guess, is first quarter next year in terms of earnings for banks?
The way it's going to show up, I mean, it really depends on the composition. For most the U.S. banks, it's going to be fine. At the same time that you have this progression of delinquencies moderately going higher, for the biggest banks, they have other big engines in terms of fee income in their investment banking businesses and their wealth management businesses. And one thing that you heard of the last 2 weeks is investment banking backlogs are the highest level they've been in 3-4 years. So you have this weird dynamic of, again, you're seeing stress at the lower end of the consumer, you're seeing delinquencies rising, but corporate America and CEO confidence is high. They're ignoring a lot of this noise. They're excited about the prospect of a deregulatory environment. They're excited about Fed easing and the cost of financing going down, albeit just modestly, but going down, and are in somewhat expansion mode, not full scale expansion mode. The one place we're seeing that, is in AI, but you're seeing, a real return to deal activity. The question is going to be if you start to see actual real cracks in the armor, if these one-offs actually pick up more, and we haven't seen that yet. And one of the reasons is it's this weird dynamic of growth has been slower for banks. They haven't grown their loan portfolios as much as they want because they face this competition from non-banks, primarily private credit. And at the same time, while they bristle about that, that's actually kind of propped up asset values, particularly when you look at things like commercial real estate, where you thought there was going to be great challenges of, one, rates are higher debt service, two, challenges on remote hybrid work. And
Everyone's back to the office, right? So,
well, and to a degree, but some of those properties are still pretty challenged. I mean, you've got some things underwritten, at 2019 levels that when the loan's coming due and they could have 5-year, 6-year terms, they'd have to refinance it, and re-underwriting that property at today's levels, not that attractive. But one of the good news for the traditional lenders is the competition that I alluded to is coming in from outside the sector. A lot of that money raised from private credit, when it came to CRE, they thought they were going to be able to purchase assets at distressed prices. But you haven't seen a lot of that. The banks haven't been forced to blow out their portfolios. They're not likely to do so. And the private credit firms aren't going to give that money back. So they've been making a lot more direct loans and helping support the broader CRE market. And you could make the same comment about the broader commercial market. Again, there's plenty of credit availability to borrowers right now. When you get, going back to where we started, when you look at cycles and when things get really ugly, is when lenders delever and hoard cash and credit's not available and suddenly you can't expand and everybody sits on it and it doesn't grow. We do not have that problem now, in part because of all of this dry powder sitting outside of the bank space.
and all that dry powder, I imagine, wants to get involved in AI, data centers. this new part of the economy that, that wasn't there in 2007.
100%. I mean, it's looking at a lot of places, but that is definitely an area that's attracted a lot of attention. And it makes sense for private credit firms to finance that rather than some banks. Big banks can get into it, but I mean, those are big projects. And that's the bull case for private credit. Big, large loans that might be a little bit further out of the risk curve, if only just for the size for a traditional lender, something that might be not necessarily hypothetical, but based on a future expectation, but could be higher reward, and would require a deeper level of attention and comfort with having a bigger exposure like that. That feels like it checks the box for private credit to me in a really good way, and we've certainly seen them go after those kind of credits, but also other big lumpy credits as well.
Who are the biggest players in the private credit space?
It's a lot of the big PE firms, honestly. I mean, you've got others for
Apollo,
sure.
these kind of people.
That's right. Apollo, KKR, Ares, Carlyle. If you look at the top 29 are big PE firms. And one of the wild things is if you look at the size of those firms today, the regulations changed a little bit in the US. But if you look at their asset size today, they would be considered a systemically important bank based on the way Dodd-Frank laid it out, which is a long-winded way, complicated way of saying they'd be effectively a top 15 bank, each one of them on a standalone basis. And I don't know, I know folks in the banking system recognize that. I think regulators recognize that, investors do, but I don't think Main Street really recognizes just how big this has gotten. And that's one of the questions we have, because when there is a cycle, there'll be issues and smart players will do okay, but there's also tertiary players who probably won't do okay. And what are the knock-on effects of that? Because one of the things that happens in a cycle too, you always see it, problems arise, banks get in trouble, and they end up in front of a bunch of politicians in Washington being asked, how did this happen? Private equity, private credit's not regulated. I mean, they'll have to answer to their investors. That's right. And they don't have depositors. So, maybe it doesn't show up the same way. But one of the lessons I had coming out of the financial crisis was a housing bubble bursting. And I remember a bank in Metro Atlanta said this to me, who got in trouble but made it through. And they said, we felt okay about what we were doing from an underwriting standpoint. But what we missed was, when you're lending against a piece of dirt, if the guy next to you is doing something really stupid, you got a problem, because the value of that piece of dirt's probably not what it should be. And that's one of the challenges here. While it's kind of a positive that it's helped support asset values, has it taken things to a level that maybe the values that we're using aren't the correct ones? Do we need an actual massive correction here because of all the money chasing after so few assets?
Yeah, my 2007 financial crisis story is around Dick Fuld, who was in Dubai at an event at the Dubai International Financial Center, and there was a media event. There was a few of us. There was a colleague from the Financial Times. I was at the Wall Street Journal at the time, and a very experienced journalist, Eddie O'Sullivan, who was the publisher of Middle East Economic Digest, asked someone who Dick Fuld would never have heard of, never have even heard of the publication, asked him a question, what's the biggest risk you see to, the global economy at the moment? And, kind of Fuld kind of pondered it, and then, one word answer, terrorism. And literally,
Wow.
A month later, the ceiling collapsed around his head and every other banker's head, and it sticks in my mind as being, slightly, either just not answering the question or, just
Out
ignoring.
touch.
Out of touch. Out of touch. Yeah, exactly. And I guess that's kind of where I'm going with this, is that, with the danger, if you're a bank and you're lending and it's open and investors can see it, the risk is more transparent. You are more in touch. You're more in touch with your customer. You're more in touch with the street, you could argue.
You could, but one of the things that I continue to talk to folks about, I get to go out and talk to bankers across the country, and they don't always love this message. But I say if you go back to 1945, we've had a recession in the US almost every 8 years. We're pretty due. It doesn't mean that one is coming tomorrow, but the pandemic didn't really count. Yes, we papered over it with $5 trillion in stimulus and forbearance and paycheck protection program loans, and then another $5 trillion in Fed balance sheet expansion. But there was not really air let out of the economy, and it wasn't a bubble, so it was an unusual time. But you honestly have to almost go back to 12 or 13. That's pretty long in the tooth. And as long as I've been doing this, the good banks had money when no one else had money. And the way they did that is they didn't chase and run after the new thing, and they were conservative. So I'm increasingly trying to sound the alarm of saying now is the time to be very thoughtful about any new dollar of capital that you're extending, or any new dollar of loans you're making. Because as I said earlier, it sure feels like we've got to be closer to late cycle than early cycle, not just only on the length of this expansion, but some of the things we're starting to see. We've seen stabilization in delinquency trends. They've rose for 10 straight quarters off of historically low levels, but we're starting to see those one-offs pop up and expect, I mean, we've got a forecast out there. We expect them to go up pretty considerably next year, but nothing akin to a really serious event. So broadly, space does okay. And there'll be outliers, though, who absolutely miss that. It always happens. Everybody thinks they've kind of gotten it figured out. And that the combination of that, of excessive valuations and excess leverage, and thinking that you're not going to have a problem, I think is what always leads to downturns.
Yeah, of course, you can never see the top. What impact does the Fed have in all this? In fact, what agency does the Fed have in all of this? I'm guessing because there's more cuts predicted. They're under a lot of pressure to cut, certainly.
Mm-hmm.
Obviously that's going to make lending more affordable for borrowers.
It helps. It helps. I mean,
Right.
one of the weird things about it is that, again, going back to the consumer-driven economy, when rates went up, they weren't as impacted because they had so much fixed rate debt in terms of their mortgages, so they weren't as impacted. That means they're also not going to get as much relief as you might think they would on the way down. For corporates, though, it definitely matters. You haven't seen, not everything is priced off of short-term rates, though, and you haven't seen the yield curve move down all that much. You're kind of seeing it gyrate all over the place, and some of that is Fed expectations. Some of that is things like tariffs. Some of that is deficit. So there's other things at play here, but the Fed can definitely help. One of the challenges that they have is, I think for some time they've been in the camp that they want to make sure that inflation is dead below the 2% level. They're not there. They haven't gotten there. And they're very fearful of going back to the 70s and the lessons of Volcker of cutting too fast, too soon. So I think it's one of the reasons why we haven't been lower sooner, given the weakness that we see in the labor market. We are expecting more cuts, and that kind of helps. But the good news is we've gotten this far, is kind of the way I think about it. If you had the consumer cracking, or not even cracking, getting stretched to the level that we're seeing today, call it in 23, particularly after the regional bank crisis, or even early 24, it would be a much tougher place for the Fed to be in. But the economy's been resilient through that. And so we're kind of getting to the other side where inflation is tampering down to a degree, and cuts should help ease that. But I don't think it stops a cycle from happening.
You mentioned the labor market, but I think if I go back to 2007, if I'm right, there wasn't a particular strain on the labor market then, right?
No, and that's one of the weird things. It doesn't really show up until it sort of does. In that case, we had some pretty effective triggers where you had huge mispricing of risk, huge mispricing of assets, and then a huge unwinding of leverage driven by Wall Street and the banking system getting in trouble. The big banks at that time were levered anywhere from 25 to 30 to 1. They're levered about 10 to 1 today. So when they had helped prop up the housing market with a lot of subprime mortgages, or even worse, synthetic CDOs that were tracking said mortgages, so leverage upon leverage upon leverage, the unwinding was massive because not only sent property values down considerably, but it meant they had to hoard cash, as I said. They all suddenly needed to raise money and couldn't extend it. And that meant that it put all kinds of stress on all kinds of corporates. And they had to hoard cash, which meant accelerated layoffs. You don't have that kind of system set up the same way, at least with the banking system. One of the challenges here, though, is that you've got the shadow banking system and private credit propping up a lot of things. And what would be the trigger that could cause an unwinding there? It doesn't work quite the same way, but it's one that we talk a lot about, and the smartest bankers we know don't really know how to predict that. That could you actually see sort of a cascading? They're not funded the same way as banks. They have committed capital, but they are funded by banks. So if you start to see banks really pull back on some of the lending that we were alluding to earlier on loans to non-depository financial institutions and start to say, we're really concerned about that, that would be something that could really accelerate stress and maybe have a cascading effect. We haven't heard that yet, though. Even the banks who had some problems described them as one-off and said, we feel good about this portfolio.
Andrew Bailey, the governor of the Bank of England, he was testifying to Parliament, a parliamentary committee this week, and he flagged this risk from some of these more opaque lending markets as a potential risk to the economy, financial risk. What does Jerome Powell say about it?
I mean, I think they're watching it. They're also very careful to say too much about it. And one of the challenges here is that they don't know anything more about this than we do. They're unlike with the banks. They have confidential information that we don't have. We have great data here at S&P, and we can get really granular on the banking system. With private credit in particular, it's very high level, and the public companies out there will provide disclosures, and so you can dig into it to a degree. The place you get better is when you look at specific deals that have maybe traded and you could tie to a specific company and see there. But it's really hard to get a holistic view. And I think it's one of the things that makes banks and traditional lenders very nervous and quick to say that the problem is likely outside of the system, because they understand they need to be regulated. They struggle with that sometimes. It frustrates them. But they will gladly share that they feel plenty of pressure from their regulators to focus on the quality of what they're doing. But they don't think that that's happening at all in the private credit arena. And it's not because they're not regulated. They faced scrutiny from investors, but it's not the same thing. They don't have examiners there. I mean, JP Morgan has several floors in its headquarters dedicated to regulators who are there year round. That's the way it works. So it's a very different thing. And I think it doesn't mean that I think that they don't have an opinion. I think they're just careful saying, we know risk has been pushed out of the system and we're watching it.
So the way this ends is that they end up having to testify, are forced into disclosing far more information, and they cease being private in the way they operate and being very public in the way that they operate. Well, I imagine.
That's a scenario. But I'll give you another one where maybe this is the way post GFC was supposed to work. You push risk out of the system. You don't have depositors' money as much at risk, and wealthy people lose some money. not most of the globe. And yeah, there are some pension funds who've invested here, and so maybe you could see some dicey things there. But if we push risk out to the system and it went to riskier investments that were funded by higher net worth individuals, and there's some loss content there, maybe that's the way it's supposed to work. The question is just how ugly does it get through a cycle? And we will have one. I'm not saying it's tomorrow, but we will have one. How ugly does it get? And what knock-on effects would it have to the economy? If it actually leads to delivering, then yeah, I think you're right. I think that's where you get there. And Brian Moynihan, the chairman and CEO of B of A, said yesterday, I was at an event the American Bankers Association annual convention, where he was calling for the regulation of private credit firms for exactly this reason, because banks are worried that there could be a problem created outside of the system, and then it'll end up spoiling the party for them.
Nathan, this has been fantastic. Great conversation. Positive note to end on. What should we look forward to?
I think things are pretty good. We focus a lot on how scary things are right now. The line I always come back to is I remember a lot of the silly things I saw in 06 and 07 that I don't feel like I'm seeing as much today. We'll get a downturn, but we'll get through it. And people are generally cautiously optimistic. So let's hope that continues to carry through the day.
What doesn't kill you makes you stronger.
That's right. That's right.
Nathan Stovall, thank you so much. For listeners of the Look Forward podcast, I strongly suggest that you check out Nathan's podcast, Street Talk.
Yes.
That's the one, which is available on the S&P Global.com website. It will be also available, I suspect, on YouTube, Spotify, and the Apple Podcast Store, just like this podcast, the Look Forward podcast. Thank you so much for joining us, and look forward to the next episode. Thanks.